Good morning. I'm Jim Weinberg. I am chairman of the law firm of Hirschler Fleischer. It's my pleasure to welcome you this morning and thank you for joining us for the 15th annual Edward S. Hirschler Memorial Professional Advisors Seminar. Today's seminar is made possible through the generosity of the Bon Secours Richmond Healthcare Foundation, and I want to thank them for their generous support. I also want to thank Glenmede, the Foundation's investment manager, for its support. And finally, this program is also made possible through the support of the Edward S. Hirschler Memorial Charitable Endowment Fund of the Richmond Jewish Foundation. This, I hope, is Ed Hirschler. Ed was the co-founder of the law firm of Hirschler Fleischer. He was also an influential early chairman of the foundation. The foundation's enduring charitable contribution to the Richmond and general community is in part a testament to the vision and actions of the early leaders of the organization, such as Ed, and those who followed him. Shortly after Ed's death, Hirschler Fleischer established the Edward S. Hirschler Memorial Charitable Endowment Fund. The fund provides support for an annual seminar to enhance educational opportunities relating to charitable giving and estate planning for legal and financial professionals. Thank you for helping to honor Ed's memory. With your participation in this seminar devoted to the values he held dear, learning, professionalism, and philanthropy. The Richmond Foundation is proud to serve as a resource for the Jewish and general community with respect to charitable giving. As you work with your clients and the topic of charitable giving arises, we hope that you will remember the Richmond Jewish Foundation. Now, I'd like to welcome Ann Capron, President of the Bon Secours Richmond Healthcare Foundation.
Thank you, Jim. My foundation colleagues and I are delighted to join you this morning. Bon Secours Foundation raises charitable funds to support Bon Secours Richmond Health System. The only faith-based health system in the Commonwealth of Virginia, Bon Secours Richmond now includes 7 hospitals, a college of nursing, an extensive network of ambulatory care centers, primary care and specialty clinics, and many community health programs. This certainly has been one extraordinary year for everyone. I'm especially humbled by the dedication, skill, and courage of my caregiver colleagues throughout this time of crisis, and also by the generosity of our community. In order to meet the present and future demands of healthcare in the communities we serve, Bon Secours depends on contributions from people who believe in our faith-based, mission-driven ministry. You help many of your clients who want to make a difference in our community through philanthropy, and we are grateful. We're excited about the opportunity to learn beside you today, and now it is my pleasure to introduce our speaker, Martin Shenkman. I hope you've had an opportunity to read about Martin in your booklet. We are fortunate to host someone with his academic and professional experience and accolades. There are many impressive accomplishments in his biography, but there is one that I wanted to highlight for you. Martin founded chronicillnessplanning.org, which educates professional advisors on planning for clients with chronic illness and disability, a specialty that could not be more timely. He has written books for the Michael J. Fox Foundation, for Parkinson's Research, the National Multiple Sclerosis Society, and the COPD Foundation. Please join me in welcoming Martin. Thank you.
Thank you, Ann, and thank you for selecting that to highlight, because that's far more meaningful to me than most of the other things. First, I apologize to everybody. I got something in my eye this morning walking the dog, so if I'm twitching and blinking and my eye is watering, just forgive me. I'm going to try to share my screen, and I would really be grateful if somebody could confirm that they see the PowerPoint on my screen. Let me get rid of this. it's in Word, and I'm going to get rid of the navigation screen momentarily. But is that visible to everybody?
It is, Marty.
Okay, and I'll make it bigger if that helps in a minute. The reason I'm asking, and forgive me again, but I did a webinar for somebody recently, and I didn't know that the screen share had not clicked through, and they didn't tell me until after the program was over, and I certainly didn't want to repeat that. We're living in very difficult times, and I encourage all of you to not only speak to clients about charitable giving, but to find ways, extra ways that we can all give back. I can tell you that personally, in this very difficult time, the extra efforts that I've been able to make in terms of charitable giving, from helping different charities with more webinars than I've ever done for charities before, helping a local food bank, and on, have been a great source of comfort for me during this difficult time. It at least makes me feel that I can have some positive impact on the difficult world we're living in. So that's certainly important. Let me make another comment too, and this is off script, so forgive me, but I do think it's important given the introduction that Ann gave, and this sort of charitable base of the whole program that we're doing. Many advisors that I consult with and deal with often feel, if the client wants to talk about charitable giving, I'll discuss charitable giving. But I think it's okay, and I encourage you all to think about it, for us to proactively encourage clients to make charitable contributions. I don't believe that it's our right to tell clients where to give, but certainly about the benefits of giving. And it's not just tax planning. Too often we focus on the tax planning of giving, but just as I shared personally with you in Ann's introduction, it's a great feeling for us individually when we give back. And I think it's a great feeling for clients when they give back. I often explain to clients when we have these discussions that estate planning should not merely be about the transmission of wealth, but about the transmission of values. And what more beautiful way can there be to educate future generations than to make contributions as an example to help them understand? So that's a little off script comment or two. Now, the materials that I'm presenting are based on a PowerPoint, but I have a Word document. I've never done that before. Forgive me if it doesn't look as crisp and clean, but I thought it was great the way the foundation organized the materials for you today. And because of the way they organized them, what I did is, it was too hard for me to take notes or put markers on a PDF, maybe my lack of technical skills. So I converted the materials that you were given into a Word document, highlighted them so that it would make my presentation hopefully smoother and enable me to jump around to some different topics. So if it's not quite as beautiful on the screen as the PowerPoint itself would be, forgive me, but I think it will hopefully enable me to do a better job for you today. Now, let me just tell you about what's in the PowerPoint. The main discussion that we're going to have, but we're going to talk about other things as well, is charitable planning post-Secure Act and using charitable remainder trusts as a beneficiary for retirement plan assets. I may just refer to them as IRAs, but it's retirement plan assets. That's a huge topic. I don't know how many of you have heard Secure Act presentations, and what I'm going to do is talk about the Secure Act generally, because talking about the use of CRTs post-Secure Act without explaining the Secure Act doesn't really work. So I'm going to discuss the Secure Act with an emphasis on charitable issues. I'll talk primarily about CRTs in the context of the charitable issues, but also about QCDs and a few other things. I'm not going to give a real primer on CRTs. We won't have time for that. If you want some good primer information on CRTs or information on what to do with existing CRTs that perhaps because of decline in asset values are perhaps on the cusp of imploding, on my website, shenkmanlaw.com, there's several videos, webinars, recordings you can access anytime that will give you a much more detailed discussion of CRTs. So that basic will be there. Now, the other thing I'm going to do is I'm going to jump around and talk about a few other topics, because in planning for today's program, and I'll get rid of the navigation pane on the side and try to make this bigger if that helps. And please, somebody on the call, if you feel that something is not visible well, tell me and I'll adjust the screen to make it easier. So before we get into the Secure Act, I want to talk about just a couple of general topics, and one in particular, because the theme for today was charitable planning, and I was asked to talk about charitable planning, and there's some wonderful organizations that hopefully all of you can benefit and your clients can benefit with such planning. So let me just make some general comments. One, Democratic nominee Biden, and any comments I make, by the way, about political matters are not political. I am totally not being political. I'm being a tax attorney and nothing more. So you can't be offended because I'm not speaking politics, just tax planning. Capital gains rate. Democratic nominee Biden has made it very clear that he wants to increase taxes on the wealthy. One of the many things that he's talked about is eliminating basis step up on death. That remains to be seen if that will happen. It remains to be seen what the election will be. The layers of uncertainty are huge. We have no idea, no way to predict the election. We have no way to predict not just the presidential election, but the impact on the Senate and the House. If there is a Democratic sweep, we can, I think, almost bet assured that there will be very substantial increases on wealthy clients that will dramatically change the planning environment as we know it. And right now in 2020, what I'm seeing, and I suspect all of you are, is an incredible crush of planning that makes even the crush of planning at the end of 2012, it eclipses that. I'm seeing more people with more wealth planning more aggressively now than even in 2012. And 2012 was a tidal wave of planning as people feared the exemption would drop from 5 million to 1 million. Let's just talk about that for a second and then talk about the implications and how all of you as advisors can use that to benefit the charitable causes that are the sponsors for today's program. So the environment today is different than 2012. We're looking at a potential drop in the exemption, depending on what may happen, from 11.58 million. The current number could drop to the 3.5 million. That's the figure that was in Hillary Clinton's proposals. It was in the bill that Bernie Sanders introduced to the Senate, that Congressman Gomez introduced to the House. It was in President Obama's Green Book, I believe, every year that it was issued. I saw one indication that Biden was talking about cutting the exemption in half, so it may be 5 and change, not 3.5. But whichever way you slice it, that's a massive reduction. And I think that one of the major drivers of planning today, estate planning at the end of 2020, is trying to use exemption before it may drop. I've never heard as much talk as this year, and I may take blame for being one of the contributors speculating, but it's all speculation, that if the Democrats do sweep, and again, not a political statement, just a question really for us as planners, that we may find that if they do enact legislation mid-2021, for example, say May, June, July, what if they made it retroactive to January 1? Now, I only speculated that, but that seems to be another one of the driving assumptions behind planning. There's a frenzy of activity, at least that I'm seeing, and I suspect most of you are as well, to get planning done by year end, because we don't know what effective date, if there's a Democratic sweep, and if they gain control of the Senate and the White House to be able to push through tax increases, that what if they make it effective retroactive to January 1? One of the reasons for that is really sort of the social goal of using the tax system to modulate or reduce the wealth disparity in our country. And if you make the changes retroactive, it'll cut off a massive number of people that may try to do wealth transfers after they see the election. Now, just like most tax law changes that we see, many, if not most clients are still sitting on a fence saying, let me see what happens with the election, then I'll decide. So a retroactive tax date might just cut off planning by all of those people. So that's what I see the driving force right now. And I didn't really prepare materials on this, I'm sorry. But I think that is important to talk about. And I want to tie it back momentarily to charitable planning from a couple of perspectives. One of the proposals that Democratic nominee Biden has talked about is eliminating favorable capital gains rate and taxing capital gains as ordinary income. I can't remember, but I know we had that situation some years ago. I'm thinking in the 80s. I may be wrong, but that's not the first time that we've had no preferential treatment for capital gains. So we very well may have that kind of change. Now, that's really important and will have a dramatic impact on charitable planning. First, if a client is going to donate appreciated stock to charity, might it pay to wait and get a more valuable benefit by doing it post-election? That's certainly possible. Also consider what this does to charitable remainder trusts. And again, speculation, but I think an important caveat to note to clients. There's been a lot of talk about CRTs of late, and we'll talk a little about them later. And I've given you a lot of materials beyond the Secure Act PowerPoint. There's an extensive article about using CRTs and the mechanics and economics of them that are in your materials as well. And I'll briefly show you those, and if we have time, make a point or two about those as well. But what if you fund a CRT today, and the CRT sells stock, whether now or in the future? One of the ideas of a charitable remainder trust, let's use the traditional or common technique of a bailout, a business bailout, charitable bailout. What that technique involves is taking a slice of a family business, donating it before the sale is solidified, and it obviously should be far enough in advance of that sale being solidified, that when the business is sold, some portion of the ownership interest, the equity in the business, is held by a CRT, and current gain is deferred. And then what happens, as you all know, when you have a charitable remainder trust, that deferred gain, as the payments are made out to the taxpayer, to the client, and in the current very, very low interest rate environment, you're going to more likely than not have a CRUT, a charitable remainder unitrust, with the unitrust payment out. The income flows back out to the grantor, to the donor, subject to the 4 tiers. So what might happen is it's not an elimination of capital gain, as you know. It's really a deferral, and it flows back out as the unitrust payments are made to the client. But think of what that may mean in the context of a Biden tax change. If somebody sold stock in their family business before the end of the year, and if people feel that, or see, and many will wait to see, if people see that there's a Democratic victory of sufficient substance that these kind of changes may go through, we may see an incredible flurry of stock sales and asset sales before the end of the year, as people try to sell their businesses at a capital gains rate that may be half of what it'll be starting in 2021. Should you use a CRT? Common plan that I've seen over the years of practice is a client will put some of the stock, say, in a CRT, so that they get a charitable deduction and they defer some of the gain. Some of the stock they'll put into trust from an estate planning perspective, so that they can remove some of that gain and appreciation out of the estate and lock in discounts. And then some they leave in their name, so after the sale they have cash for their own purposes. But the piece that goes into the CRT, are you hurting or helping the client with the CRT? The goal is to help the client get a charitable contribution deduction and defer that taxable gain until those distributions are made back as unitrust payments to the client. But if under a Biden administration, capital gains receive no favorable tax treatment, does the use of the CRT actually harm the client? Would the client rephrasing it, be better off selling that family business interest and reporting a taxable gain in 2020 at the current, call it 20% rate, rather than waiting till 2021 and having a CRT defer that capital gain to a year when there's no favorable treatment for capital gains. In other words, you may be shifting a capital gain to a future year where when it comes out of the CRT, the tax rate is double that it is today. So we really need to carefully rethink what we're doing in terms of CRTs for not only charitable bailouts, but capitalizing on some of the highly appreciated stock position. The client has tech stocks that have gone up dramatically, wants to use a CRT. Is that really the optimal approach? Might they be better giving some directly to charity and selling the rest now rather than using a CRT? So we really need to rethink it. And I think if a client is going to do a CRT to defer gain, we need to warn them that if there's a change in Washington, they may well be deferring those capital gains to a much higher tax structure. Now, that was one point. The second point I wanted to make about charitable planning today, and I think it's worth taking a few minutes for those that aren't familiar to explain it. And this is an interesting opportunity to create charitable donations from clients that had never been charitably inclined, and to create charitable donations that would not have otherwise happened. And that's using a charitable spillover on a note sale transaction. So what I'm going to do is take a few minutes and explain this, because I think it is a huge planning opportunity for all practitioners now. And it's a wonderful opportunity for, if there's any development officers on the call, to reach new clients that have significant wealth that just have not been charitably inclined. So let me set the stage. I've already talked to you about 2020, which I'm sure you're all familiar with, but I felt it important to set the stage. Now, a piece of, and the prime piece that everyone's talked about for 2020 year-end planning is using the exemption in case it should decline next year. But that's only a part of the story. And this is also what makes 2020 very different and much more complex than 2012. And that is the following. The Democratic proposals that I've talked to you about a few minutes ago also include a whole array of other restrictions that will rewrite, restructure completely everything estate planning is about. How so? Some of the things the Democrats have talked about include a potential tax on dynasty trusts. So, for example, one of the proposals that had been floated is every 50 years, every trust will be subject to a GST tax. Now, that may not sound like a lot every 50 years, but if you automatically assess a tax at 40, 50, who knows how high they'll raise the rate, 60% on every trust, dynastic planning as we know it will be dramatically curtailed, because the benefits of compounding assets outside of an estate indefinitely, which has been the heart of dynastic multi-generational planning for years, will be decimated by such a proposal. And I don't even know if Congress would realize the impact something like, or maybe they actually wouldn't be doing it intentionally. Now, what does that mean? It means that clients with any level of wealth want to use GST exemption as soon as possible, ideally this year before a law change, if that happens, because it is possible, and I can't predict, none of us can. My Ouija board burnt out many years ago, so I used to be able to predict tax law changes, but I can't do it very efficiently now. If we have a trust set up and we allocate GST exemption to it this year, might that be grandfathered? Might that be grandfathered so that if the Democrats do sweep and do enact a tax law change such as a GST tax assessed every 50 years, no matter what, on every dynasty trust, might that only apply to trusts formed or funded after January 1, 2021? So it behooves all wealthy clients not just to use exemption, estate tax, gift tax exemption, but to use and secure GST exemption and get dynastic trusts in place. Other changes that have been talked about include a restriction or repeal of discounts. And many of you may remember when a few years ago there was talk about 2704 regs that would virtually eliminate discounts on many transactions. A flurry of activity as clients tried to get discount planning done. So right now, if you have clients that may face the loss of GST exemption through that dynasty trust tax every 50 years, or it could be 25 years, we don't know, loss of discounts, and a whole other range of planning issues. Another one that's been talked about in several Democratic proposals, and I think this was in President Obama's Green Book proposal in his last year of office, I don't know if it was in prior years, was that assets in a grant or trust would be included in the settlor's estate. That completely decimates planning as we know it. Now, if a transaction done this year is grandfathered, think of how incredible all these different things that we've talked about can impact planning. So if a client can lock in discounts on the sale of a family business to a dynastic trust and avoid that tax every 50 years and avoid estate inclusion, it's beyond a grand slam to get that done this year, the next year. So what I'm seeing an awful lot of is large clients where the where the use of exemption is only a down payment on their planning, doing note sales and other types of transactions to lock in discounts and shift huge amounts of wealth into dynasty trusts before the end of the year. Tremendous amount of that. And I suspect all of you on the call are seeing this as well. What does this have to do? What does this have to do with charity, and how can we use this as an opportunity to help the wonderful charities and foundations involved in today's call? I'm going to walk you through an example of a sanitized schematic for a transaction that I'm working on. So here it is. Let me explain the transaction. Let me explain the role of charity, and let me explain how each of you can help introduce clients that have not been particularly charitably inclined to be more charitably inclined. I'm going to try to adjust the view so you can see the whole screen on this. Let's see if this works. Okay. No, that's not what we want. Sorry about that. Give me 1 second, folks. I don't know how to get rid of this other page. I'm trying to enlarge it so you can shrink it so you can see it, but I didn't want to confuse you with 2 pages. So let me explain the transaction that was involved. Let me explain how this ties into some of the most common 2020 planning most of you, if not all of you, are involved in, and how there's a charitable component to it that can help your client, help charity, and do good. So one of the most common default planning techniques for 2020 planning, certainly for married couples, but it can apply otherwise as well, is use of non-reciprocal spousal lifetime access trusts. I'm going to explain it in 30 to 60 seconds. I'm sure many of you are familiar with it. If you're not that familiar with SLATs, you should be, because it's going to be the foundation of many of the plans you're going to do between now and year end. On my website, Shenkman Law, there's 3 or 4 different SLAT webinars, including a 2-hour deep dive explaining SLATs, how they work with sample drafting clauses as well, that I did with Jonathan Blattmacher, if you want to access that to get some more background. But SLATs are very simply, and I'll use me as an example, I'll make it real. My wife and I, the core of our plan is 2 non-reciprocal spousal lifetime access trusts. I set up a trust for my wife and all descendants in 2012 in Alaska. My wife set up a non-reciprocal, somewhat different, so that IRS or creditors, and creditors were certainly something we wanted to protect against, different trust in Nevada with a different trust company to benefit me and all descendants, including our adorable grandchildren. Those 2 trusts for many of your clients will be all that's needed, and they use exemption by gift transfers to those trusts. And keep in mind, as I said earlier, and just let me emphasize, even though it's not our key point of discussion today, is that even clients that are not able to give huge amounts of money, grandfathering GST exempt grant or trust may alone be worth all the planning. Now, for your larger clients, like this illustration here, just setting up the non-reciprocal SLATs is not enough. And by the way, the reason I use different jurisdictions, Alaska, Nevada, in my personal example, is I think that helps differentiate the trust for breaking a reciprocal trust challenge. And by the way, one of the common ways to differentiate trust for two spouses is to have them done at different times. But if you're creating trusts in October for clients that are going to complete a transaction by December, you're already having not very much time to differentiate them. You do husband's trust in October and the wife's in November. Not a lot of differentiation. So you need other things, and that's why I like to use different jurisdictions, but especially at the end of 2020. Now, this particular client is going to do a very large note sale transaction to each of their respective trusts. So what we did is we took the controlling interest, let's call it the general partner, and we gave that to a different trust than the slats so that it wouldn't be in the same trust that have the limited partnership interests, so that it would help support the discounts. And we certainly wanted to divest the matriarch and patriarch of any control interest in the entity. So in this first slide here, we set up, just like I illustrated, in Alaska, Nevada, non-reciprocal slats, and each of the clients gave $100,000 to those trusts, and they gave a smaller gift to fund a third trust that will ultimately hold the controlling general partner, could be voting stock interests. And the final box on this illustration is a donor advised fund that we created. And here's the charitable planning component and idea to that. And I'm going to explain this as we go. They made an additional nominal gift of $10,000 just to fund the trust, the DAF, the donor advised fund, and get it going. Now, very important as I go through this illustration, this will be a common planning tool for larger clients doing sale transactions to lock in discounts, dynastic planning, freeze asset values out of their estate, and so on. And for a lot of our clients, this is very opportune planning. Although the FANG stocks, the large high-tech stocks have gone up incredibly in value, lots of client business interests, especially real estate, entertainment-related industries, businesses are still very depressed, and it's an opportune time to get those out of clients' estates before they recover. Now, if the particular charity that you're looking to benefit will not accept, and many won't, the type of funky asset, that's a technical tax term, funky, that I'm going to describe, no worries. There are donor advised funds that will act as donor advised funds for charities who specialize in accepting unusual assets. They are willing to take on that risk and the complexity of it, and then in effect roll the money back to the particular donor advised fund, foundation, or charity that you're trying to benefit. So if the particular foundation that you're trying to help will not accept this, and assume many won't, don't despair. You can still do the transaction and benefit the charity that you desire. So the next leg of the transaction is we gave interest in entities to the trust to further, if you will, the seed gifts before a note sale transaction. And that's what's illustrated here. The donor advised fund is not addressed here because the donor advised fund received some cash as a starting point, and you'll see what comes next, unless you've already anticipated that. So what you try to do to avoid an issue like the Pierre case is fund these trusts, the non-reciprocal slats, with seed gifts that are different, if possible, than the asset you're selling. And that's what we did here. This was a business client, but we used real estate, smaller separate real estate properties to fund the seed gifts. Now, as illustrated here, and this is part of the overall defined value mechanism, we use Wandry clauses on these transfers. Let me pause and explain in case that's unfamiliar to some of you. So a defined value mechanism is an adjustment clause that seeks to deflect an IRS challenge as to the value of an asset. So if a client were to gift us here, call it $11 million of assets to a trust to use their $11 million exemption, and the IRS comes back and says, no, stop, that $11 million real estate LLC is actually worth $20 million, and you understated dramatically the gift tax implication. You have a $9 million taxable gift. That's a bad result. Now, there's many different types of valuation adjustment mechanisms. One of the commonly used ones is called a Wandry clause, which is based on the Wandry case where the court supported this. The IRS non-acquiesced, so you should caution clients as to the fact that the IRS will still challenge these because they non-acquiesced to the Wandry. There's another type of king adjustment clause where you adjust the value of the note in a note sale. We're not going to illustrate that, but we'll show the Christensen type of spillover clause momentarily and how charity fits into that. So now we make these gifts of different assets in order to adjust it. Now, the way the Wandry clause works, just to illustrate for those that aren't familiar, is the following, very simple example. I'll use the same numbers I just used. I gave $11 million of LLC interest in a real estate LLC. The IRS comes back. If I gave 100% of those interests, the IRS is going to come back and say, no, the real value of that LLC was 20 million, not the 11 million that you put on it, and therefore you owe a $9 million gift tax. Well, what a Wandry clause does is say, stop, I'm not transferring the ABC LLC to this trust. I'm rather than transferring the 100% of the LLC interest, I'm transferring $11 million of the interest. I have an independent appraisal by a qualified appraiser that says the 100% interest is worth 11 million, but I'm not transferring a specified percentage of interest. I'm transferring a specified dollar value of interest. So if the IRS comes in and says, Mr. Shenkman, your client is in error here. The value of that 100% interest is 20 million, not 11 million. I say, stop, audit over. We didn't transfer 100% of the LLC, the assignment and transfer documents, and make sure you carry it through in the operating agreement and the tax returns and illustrate in a attached chart to the K1 for the tax return that it was 11 million of LLC interest, not 100% of the LLC. So we only transferred 11 million. The remaining shares never left my hands as the transferor. So there's nothing for you to tax. Now, you still may have to horse trade with the IRS because they don't necessarily accept Wandry, although I've heard some good results on audits, but different issues. I apologize. Some of the arrows got a little goofed up in my conversion of the PDF that you have in front of you to a Word document, but let me illustrate what we have here and illustrate how you use charity in a more robust defined value mechanism. So say that this client funded the $11 million to their SLAP, and then they're going to use a note sale to sell a multi-$100 million interest in a family business to the same trust. Now, some people, many people, unfortunately, suggest that you need a 10% seed gift. That's as mythical as the Chimera. I don't see, I hope I pronounced that right. I don't see any basis in the law to say you need a 10% gift. I think it's completely arbitrary. The problem has become that so many practitioners have talked about this mythical 10% beast that you kind of almost want to do it just because you don't want to be the low-hanging or different fruit, right? You don't want to be wearing green shirts when everyone's wearing a white shirt at work. So we've made our seed gift. Now we're doing our sale of, in this case, limited partnership interest. Now, I'd like to do something more robust than a Wandry clause. I use Wandry on the gift because that may have entailed an $11 million transfer, so there was exposure. It's certainly worth some type of valuation adjustment. Although, for full disclosure, there are those colleagues of ours who feel that you're better off just having a solid valuation and not having any of these mechanisms. So there's as many different, more flavors than Baskin-Robbins. I don't know if you have Baskin-Robbins where you are. I think they're national. So 31 flavors. When you make the sale, we could use a Wandry clause on the sale as well. We could say that we're selling $100 million of value of LP interests so that if the IRS says it's worth 200 million, it's only 100 million of interest or half the estimated LP interests that are transferred. But maybe there's a better way. And you can't weigh the relative risks of any of this. So if I want on a larger transaction, a more robust transfer, here's what we can do. Understand in Wandry, if the client only gave 11 million of interest in the LLC, as I illustrated and explained a moment ago. That 11 million leaves in the client's hands the remaining interest if there's a valuation adjustment. Now, under the Powell case, if the client in conjunction with others, 2036A2, can control interest in that entity, it may arguably be all back in their estate on a challenge by the service. Now, what you can do, and this is beyond what we're going to talk about, I kind of dubbed it the double wandry. I may gift 11 million worth of value, but sign a separate sale contract the same date saying if there is any valuation adjustment under the wandry clause, those residual or remaining interests are hereby sold for gift tax values finally determined, and we'll sign a contract attesting to that sale so that I shift those values out. Now back to the slide in front of you. So the problem with wandry is you got left in the client's name a slice of equity which may not be what the plan wants. It raises Powell issues. So a better approach is for John Smith, our hypothetical client, to say, I am getting rid of every interest I have in this entity. Doesn't matter what happens, I got rid of it. I'm parting with dominion and control over all equity interests. So there's nothing left in my estate for tax purposes. There's nothing left for the IRS to argue a Powell kind of argument. Now, what happens with those interests? You don't want to just sell it all to the trust, because if there's a valuation adjustment, you now have a massive gift tax. And if we're using $100 or $200 million value for the business interest being sold, that gift tax could be massive. So what if you have a spillover clause? Client got rid of everything. Piece that goes to the trust is the estimated amount of 100 million in our example. What if the IRS comes in and says it's worth 150 million and they win? What happens to the excess 50 million? Leave out the donor advised fund for a second. I can have a spillover to a number of different places. I want to spill over where that excess value, so I've gotten rid of it, I don't own it, but where can it go? Well, one suggestion some people have made is a marital trust, but that raises some very thorny issues. Be very careful if you do that. Another approach that many practitioners use is a incomplete gift trust. And you could do that as just a separate page of provisions in the same trust document that creates the slat. And what that can provide is if there is a excess value, it spills into an incomplete gift trust. And what makes it incomplete gift? John Smith, the client, retains a limited power of appointment over the trust so that it's included in their estate. It's an incomplete gift. The IRS can't tax it. So the general spillover could be to an incomplete gift trust. What I illustrated here on this schematic is a spillover to a GRAT, so that the zeroed out GRAT, near zeroed out GRAT, will reduce to almost nothing the valuation adjustment for the IRS. Now, some people think the incomplete gift trust is the cat's meow. Other people think the GRAT's the cat's meow. There's lots of options, lots of opinions. Now let's go to the box just above, which was the whole point of this discussion for us charitably inclined folks. What about a donor advised fund? In the Christensen case, and I believe in some others, there was a spillover in part or in whole to charity. Now, most of my clients, especially if it's a family business interest, are concerned about leaving too much of a family business interest to charity. And be careful, you don't want to use a private foundation here, because that'll create problems. But you can use a donor advised fund. You want a public charity. And as I said earlier, if the particular charity your client's trying to benefit balks at accepting the interest that I'm describing, there's other funds that will accept it, and then can donor advised funds, and can shift the money back to the target charity. So you can always make that work. So what if I say, if there's a adjustment of value, we're selling this LP interest for $100 million. We think it's 48.4% on this schematic. If the IRS revalues it at 150 million and they win, the first 10 million, or whatever the dollar figure, here I used 5 million because that's what the client was comfortable doing, but certainly the more the better. So the first 5 million of that $50 million adjustment goes to charity, to the donor advised fund. Any excess over that amount will then go to a near zeroed out GRAT. Now, what I like about that concept is it follows the pattern in the Christensen case. So we're trying to pattern after a court case where the taxpayer was victorious, and that has an appeal if you're stuck in court arguing it. So what we've done is we gave this donor advised fund on the schematic I illustrated earlier $10,000. We're going to give it a small slice, call it 0.1% of the LP interest, so it has skin in the game as part of the sale. So when I'm doing a sale to the SLAT, which is the second box, I'm going to gift 0.1% of the same equity interest, same asset, to the donor advised fund. So again, you need a charity that can accept that. And any excess value over the defined value clause that we defined in my hypothetical is 100 million. The first 5 million of any excess adjustment by the IRS goes to the donor advised fund. Now, I don't know how the IRS assesses a tax on a transfer to a public charity. I don't know how they can. So that seems to be a pretty robust defense mechanism to a valuation adjustment. Think about it also from the charitable perspective. So we've taken a client that has really not been particularly charitably inclined. And what we're doing for them is we've now shown them how giving to charity, leaving aside all the altruistic and moral benefits of giving to charity, which I assume you all understand and believe in as much as I, but you're taking a client who's never been particularly charitably inclined, showing them how giving to charity is a great defensive tool to deflect a challenge on a massive transaction where they're shifting the family business they've spent their lifetime creating down to trust to protect it for the next generation. And doing so before perhaps the end of this year may protect it from all the harsh tax rules that could be enacted that really basically prevent this kind of planning going forward. What you've done for the charity, they got an initial $10,000 contribution to the donor advised fund. They have a 0.1% interest if it's a multi-$100 million family business. That itself is worth a lot of money. And then on top of that, there's a potential future interest of up to another $5 million if there's a valuation adjustment. What you've also done, which has nothing to do with tax planning and is something you may not discuss with your client, is you have an opportunity to introduce this client worth an awful lot of money that oftentimes has not been very charitably inclined to a wonderful charity who can help walk them through this. So that's, I think, a very opportune way to help build charitable pledges and gifts in 2020 as part of the robust planning that many of us are involved in, and many of us will get even more involved in as we get closer to the election. And the frenzy, and that's probably an apt term, that we will see this kind of planning occurring with is going to depend on what people perceive the election outcome to be. And if there is a Democratic sweep, again, I'm not making a political statement, just commenting, if there is a Democratic sweep after the election results are known, we very, very well may see a mass amount of year-end planning to do this. So let's now, that was the piece I wanted to chat with you about on 2020 planning. I hope that is helpful to you. If you were not familiar with integrating charity into defined value mechanisms and note sale transactions in the background of why that made sense, hopefully you are now. And I've talked a little bit about some other 2020 charitable implications. Now let's jump into a discussion of the Secure Act. And I'm going to give you an overview of the Secure Act and how it's changed planning, and specifically talk about some charitable implications of the Secure Act. Now, if we have a little time at the end, and if not, it doesn't matter, I've given you several articles. One is a detailed article I wrote on planning for the Secure Act, and another is on the economics and some of the assumptions of using charitable remainder trusts, which hopefully you'll find very helpful. Richard Fox and Jonathan Blotmacher co-authored the latter article. Bob Keebler and Joy Motak and Jonathan Blotmacher co-authored the first article, and those are in the materials you have. So regardless of whether we get to them or not, I wanted to give you some useful materials that would help you with your planning. So the Secure Act, and by the way, I don't know if your experiences are different, and this is the problem with webinar versus live seminars. And by the way, let me just pause for a second. The charitable efforts that my wife and I have on behalf of chronic illness charities, there's a number of different charities we support in that effort. And we usually spend 2 months a year on the road. My wife was diagnosed about 14 years ago with MS, and traveling is difficult for her. So we bought an RV and we spend about 2 months on the road. We crisscross all over the US. We usually do at least about 10,000 miles a year. This was the first year we didn't go just because of her compromised immune system. We were afraid to travel, not knowing what we would find. And certainly in May, things were closed down in so many places. We didn't know what we'd find to even where to stay. But hopefully next year or the year after, I can visit you in person. And if I were in person, I would ask the audience questions so I could get some feedback. But right now I'm just looking at myself in the little Zoom camera here, so I can't get feedback. But my experience with the Secure Act is that very, very few clients seem to get it. I sent out articles and cautionary warnings to all my clients, and I've done webinars on it that I have promoted to my entire mailing list. I don't think I've had a single client call me or email me saying, hey, can you help me revisit my beneficiary designations? Now, it's theoretically possible that they all use great wealth advisors like Glenmede, and they are getting sophisticated help to figure it all out and just don't tell me. But that can't be the case, because if they need to change a conduit trust under the Rev Trust to an accumulation trust, the wealth advisors aren't going to draft those documents, at least not yet, though I'm seeing some trying to do that, which is, I think, mistaken on their part. But I've not seen any action on this, and lots of clients are hugely affected. So even though, gee, you know, this happened December last year, it's not the hottest topic of the day, I haven't seen anyone address it. So my suggestion to all of you, if you're an estate planning attorney, encourage all your buddies and friends that are wealth advisors and accountants and insurance consultants and trust officers to talk to the clients that are also your clients and remind them that they need to address this. So I think there's an awful lot of work to be done out there. I just don't think it's been addressed. And right now, I think we're all so caught up in the frenzy of 2020 planning till we know the election results that I don't think anybody that's a professional advisor is really seeking out clients right now today to address this. But this is something that should be on your to-do list and your radar. Just from a planning perspective, what I do is the following. I use MailChimp. You can use Constant Contact. I try to do webinars to educate clients. You can, you know, we also mail out articles and other materials. You can use a one-page memo, Constant Contact or MailChimp, and just send it to your email database. You can extract your client list out of Outlook or whatever contact manager you have to import it into whatever database you use pretty simply, and send out a memo, a letter, anything to your clients cautioning about this. The other thing we do is we put footers on the bottom of our bills that address different issues. So when the Secure Act was first enacted, and for many, many months after that, because different clients get different bills in each month, we had a paragraph explaining some of what we're going to talk about now, trying to encourage clients to address it. You may want to do that not just from a marketing perspective, but if the plan the client has that you did is wrong, I don't know that you have a responsibility to go, and I'm not going to imply that to anybody as a standard of practice, but it's certainly a better practice to inform clients of those changes. So those are some pretty inexpensive ways to try to reach your entire client base. So pre-Secure Act rules are still in effect. And hey, by the way, any of you who think it's not possible for Congress to have a tax law that's kind of retroactive, look at the Secure Act. All of us have some clients that the stretch IRA with naming grandkids as beneficiaries was the cat's meow of their planning. And now, bam, their entire plan has changed. And clients may have made major decisions based on what the prior law was with the stretch IRA, set up life insurance trusts to benefit their kids, bought expensive insurance, and all kinds of planning machinations based on a stretch IRA that was now taken away from them. So don't think that retroactive changes don't happen. Pre-Secure Act, the goal of much planning with retirement plan assets was to name a designated beneficiary and facilitate that designated beneficiary, grandkid was wonderfully ideal, to pull out the plan assets over their life expectancy. It gave very long deferral periods that were commonly referred to as stretch, because you could stretch out the payments. So if I'm the plan holder and I live to my 80s, I'd be pulling out my RMDs from 70 and a half under the old law, now 72. And we'll see some of that time permitting. And would stretch it out over my life expectancy. For a grandchild, imagine leaving it to a couple-year-old grandchild. The payments each year were insignificant. And meanwhile, all those funds would compound tax-free inside the IRA retirement plan. It was a great planning tool. If the client inadvertently did not name a designated beneficiary, DB, you'll often hear the acronym, they had to pull it out over 5 years. So if they inadvertently named their estate, for example, it was a 5-year pullout in terms of distributions. These rules still are there, and the concept still remains. So the 5-year rule still exists, and you have to still be careful of it. And this new 10-year rule that we're going to talk about was conceptually just grafted onto where the 5-year rule. Now, under old law, and this still can exist, if the plan holder died after their RBD, their required beginning date, the beneficiary could still take out the, by the way, the yellow are just highlights of what you have. The green are a few comments that I just added for our chat today. The beneficiary could pull it out over the plan holder's remaining life expectancy. And some people call that a ghost life expectancy because the plan holder has died, but yet we're still using their life expectancy, which is sort of an odd concept. Now, some of the things that we need to talk about to clients, and I think whether you're an accountant, an attorney, a wealth advisor, anybody, you need to talk about revising beneficiary designations. Clients need to revisit this. I think a large number of clients, especially if their retirement plans are small, are not going to make any changes because of this. But especially where a client has a large plan balance, they really need to rethink what they're doing. And inherent in all of this is that clients with, especially if it's a small IRA, maybe what they do is they just leave it to charity. So it's another charitable giving opportunity for everyone. Clients need to revise beneficiary designation forms when they reconsider the planning. And we'll repeat some of this as we go through it. They may need to revise their revocable trusts. We tend to create conduit or accumulation trusts inside a revocable trust and name them as the beneficiary of the plan. So the client should, if they're going to change, and we'll talk about how and what and why, the type of trust or whether they even use a trust, they may need to update the revocable trust that contains those trusts, and the beneficiary designation form that names that revocable trust as beneficiary may also have to be redone. Just sort of a practical side comment. One of the things that I've learned over the years is when we amend and restate a revocable trust, we keep the same name, John Smith Revocable Trust, Jane Smith Revocable Trust. We don't say the amended and restated. What I found happens is just wreaks havoc with beneficiary designations, account forms, and everything else. So perhaps if you use that approach that we use, you don't have to revise the beneficiary designation form if you update the revocable trust. I wouldn't take a chance. I would recommend the client do it anyhow. What if there's a date? You know, my revocable trust dated such and such. Now you have a conflict between the beneficiary designation and what the current rev trust is. Clients need to reconsider the conduit and accumulation trust. We're going to talk about it. One of the bottom lines is, and this is important because we all are hardwired to think tax, 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 tax. We got to think about the flesh and blood people involved, and an accumulation trust, even if it's a lousy tax result, but we'll talk about some creative planning techniques, both with charitable remainder trusts, BDOTs, and so on, to address that, may just be a safer option, and safer is better. If the client's child squanders all the money because there's no trust within a year, a trust, even with a lousy tax profile, could still be dramatically better in terms of protecting the child for the long term and the wealth that's trying to be passed on. We got to rethink life insurance. I don't know if there's any insurance people on the call. And by the way, if these democratic changes that we talked about go through, life insurance could be the cat's meow of planning going forward. Income tax deferral inside a tax favorable envelope of an insurance policy could be incredibly valuable. More valuable as marginal income tax rates are raised. And if we have no basis step up on death, life insurance to pay that large capital gains tax may be useful. So insurance is going to be something to reconsider. Also, insurance may have a different application with respect to retirement plans than before. So a client that may have an old insurance policy and think that they don't need to address it or wants to cancel it, maybe want to instead just repurpose it. So if as we'll see, 10 years after the death, the end of the 10th year after the death of the plan holder, that IRA has to be paid out and there's a chunk of income tax that's going to be due, and perhaps at a high marginal rate or the highest marginal rate, life insurance may serve a new purpose of being paired with retirement plan assets to address the treatment of the Secure Act. Now, the other thing we're going to talk about in a few minutes is using charitable remainder trusts as beneficiaries of IRAs. And if you use a CRUT, as you know, and if not, you'll see it momentarily, there's a mandatory calculation, a 10% remainder for charity. And, you know, insurance may be used to make the family whole in that kind of planning context. Now, at the heart of many of the Secure Act changes is this new 10-year rule. And what hang on a second. My computer is not cooperating. Nope. Give me a second, folks. Sorry. Okay. I may try yelling at the computer. Sometimes that helps, I think. So at the heart of the Secure Act changes, and I'm sure you've all heard of this, so we won't belabor it, but I think it is very important to just make sure everyone's on the same page because it's a huge difference, is this new 10-year rule. And unless you meet specific requirements, and we'll talk about it as an eligible designated beneficiary. It's a refined, specified category of what the old DB rules were. If you're not one of those 5 categories, you have to pull out, and this is the default rule post-Secure Act, your retirement plan in the end of the 10th year of the plan owner's death. So if the plan owner died January this year, 2020, December 31, 2030, you have to pull everything out. So that is a huge change from the stretch. Changes everything. And what ends up happening is if you have to pull all the plan assets out in the end of that, I'll just call it the 10th year, but it's actually the end of the 10th year of the year in which the plan holder died. At the end of the 10th year, you are pushing a huge chunk of income into a single tax year where you can run the client way up the income tax brackets and have a very high marginal tax cost, even worse in a trust. And that's part of the problem as to why planning needs to be revisited. Trusts, as you know, have a very compressed tax rate structure, whereas at about 13 grand, give or take, of income under current law, you're in the maximum tax bracket. And I think it's something like $450,000 for an individual to hit the maximum tax bracket. So trusts get nailed. But yet trusts, and this is kind of an unfair concept, Congress tends to view trusts as something the wealthy use to skirt the tax law, when in fact, the primary use of trusts is to protect assets and protect irresponsible beneficiaries from being ruined by the money, right? So the money can be protected by a trustee and doled out in a way that can be productive and helpful for the beneficiary, not harmful. Now, let me just illustrate one way you can easily extend and get around the 10-year rule. So we're going to go through the 5 electing designated beneficiaries. One of them is a child, and we'll talk about that in more detail. Once a kid hits the age of majority, they have to pull it out. We'll talk about that. But let's just take the 10-year rule itself. Now, let's say on husband's death, husband was going to bequeath assets, including an IRA, to wife, and then on wife's death, assets go to kid. Well, maybe wife doesn't need the money in the retirement plan. And the way you can figure that out pretty easily is have the wealth advisor do a forecast, do their Monte Carlo simulation, see what it looks like. If the surviving spouse won't need the IRA, maybe the first spouse can leave it to the child. And if the child is an adult and they have to take it out over 10 years, okay, so you've divided, let's say, husband's IRA into 1/10 increments. Let's say wife dies 7 years later and she leaves her IRA to the same kid. And now that has to get taken out over 10 years. There's a 3-year overlap, but in effect, what you've done with really no trust, no complex planning, no cost other than filling in a beneficiary designation, you got a 17-year period over which IRAs of mom and dad are paid out to a kid. That can almost, for some smaller IRAs, solve the whole problem, because mom and dad don't want it all dumped in the kid's lap where they're going to go out and buy a fancy sports car, which has to be red, right? All the examples of sports cars red. You just got a 17-year stretch. So sometimes, even with the complex planning that we're going to talk about, simple solutions may work. Now, this 10-year period is also kind of odd the way it's structured. In the old days, pre-secure, you pulled out RMDs, you took a slice every year. The way the 10-year period works, there's no slices. Nothing has to come out for the first 10 years. It all has to come out at the end of the 10th year following the death of the plan holder. So you could have nothing for 10 years and then this big lump sum. First of all, that makes planning problematic. What if the heir needs money to live on and was counting on that IRA? How do they get at it? What if the heir is irresponsible? And when I say kid, it could be any heir. It's obviously not a child. The only time it's actually a child is for the elected EDB for child, which we'll come to. So if you have a conduit trust, and remember, conduit trusts have to pay out by law whatever the IRA has to pay to the conduit trust. So if the new Secure Act says you don't have to pay anything until the end of the 10th year, but then you have to pay everything, have you now with a conduit trust just harmed the intended beneficiary because they can't get at anything? That's an absurd result, but that's something you need to look at and maybe change the trust that's designed to hold it. It's not just the tax problem, which we're going to talk more about, of this lump sum chunk of money in year 10 and getting it run up the tax rate flagpole, but it's the potential absence of money for 10 years, which is not what the client wants. Now, we've talked about the Pre-Secure Act, how you can stretch the IRA. That's the key benefit that's lost. Now, let's talk about one of the implications of this, and this is a very important non-tax reason why clients have to revisit all of their beneficiary designation and trust planning for retirement plan assets post-secure. The client may have been comfortable bequeathing a large IRA to the child or other heir because they knew there was this huge income tax advantage to just taking it out in the minimum increments each year. If the client's heir took it all out at one time, they'd accelerate, like the 10-year rule does in year 10. They'd accelerate the taxation of that plan and lose a lot of money and potentially be pushed into a higher tax bracket. There was also just this sort of understanding, expectation may be a better word, by many clients, that, gee, if I leave an IRA to the kid and they have to only take out the RMDs, over their life expectancy, and, that'll amount to a nice manageable sum of money every year, there was this expectation that the heir would pull the money out based on those RMDs and spread it out over their life expectancy. So there's sort of this psychic, emotional idea that that's what the kid's going to do, even if they could have just pulled it right out. Now, I tried very hard to find some statistical data on how long IRAs stay intact after the death of the plan holder. I remember reading some data on this a long time ago, but I couldn't find anything. The data that I read was I guess I thought it was shocking, but maybe it's to be expected, but some huge percentage of IRA balances are pulled out like within a year of death. Now, the data that I did see some time ago didn't differentiate by size of IRA. My hope would be, but again, I couldn't find any data on it, that people with like, a $500,000, $1 million or higher retirement plan balances, that their heirs were more prudent and would stretch that out. And if it was a $10,000 or small balance, those would be pulled out and just used for, buying a new car or something like that. But I couldn't find the data. But clients who relied, and this is the take-home point on the bottom of slide 17, clients who relied on the stretch to control how their heirs paid out the IRA need to rethink all of this. And it may make a lot of sense for them to, for the first time, use a trust like an accumulation trust, which we'll talk about, in order to control the spending by the heir. For clients who relied on conduit trust, assuming the underlying planning would pay out the IRA over lifetime, they need to reconsider that. Maybe even some of those IRAs, they'll reconsider charity. Now that we've changed the whole dynamic and all the ground rules, maybe charity is a better beneficiary for some of these plans, and certainly worthy of a discussion. So the problem, we need to reconsider how trusts are going to be used to hold IRAs and retirement plan balances. The economic value of the plan is going to be diminished by the income tax cost in that 10th year because it all comes out. And it's not only that there's a big income tax due in year 10, but under the old stretch rules, you continue to defer income tax on the growth of those dollars for potentially many decades to come. So it's not just the income tax in year 10, but you also lose all those future decades of tax-free compounding inside the plan. That has a huge economic impact on the ultimate value of these plan assets. And we need to look at trusts to address the fiscal imprudence or potential liability claims, divorce claims against a beneficiary. Once the money's pulled out, if there's a 50% divorce rate, what's the odds of that money surviving and not being commingled? And again, most of the discussions I've seen have focused on taxes, and I'm certainly doing the same. But please keep in mind the economics of all this and using a trust to protect those assets for the heir if they're large enough. Keep in mind that the 5-year rule we talked about still remains, so you don't want to run afoul of that. Now, and we'll mention this again in a minute or two, but let's talk about it at this juncture. So one of the problems of having a trust hold, an accumulation trust, hold the IRA, in year 10, all the IRA monies have to be paid to the trust and hence will all be taxable at the trust compressed income tax rates. And I said earlier, after about 13 grand of income, the trust will be in the maximum bracket. If there's a Democratic sweep, that marginal bracket, no doubt, will be much higher on higher levels of wealth. And the lumping of all the IRA balance into 1 year could exacerbate that. So what might you do? Well, one concept is to use a BDOT, Beneficiary Deemed Owner Trust, BDOT. It's under Code Section 678. You give the beneficiary the power to withdraw the assets of the trust, the income of the trust rather, and the right to withdraw the income of the trust will have that income taxed to the beneficiary, who may be in a much lower income tax bracket than the trust. So, as I said earlier, I believe it's about $450,000 of income is required for a flesh and blood person to get in the maximum bracket, and a mere 13 grand for a trust. So if there's a $250,000 IRA and you give a BDOT right, the income of the trust will be pulled out for income tax purposes and taxed to the beneficiary on the beneficiary's income tax return. That could be a very substantial tax savings. Now, the problem is if the beneficiary exercises the right, you've just defeated all the planning because the money's pulled out. But the beneficiary doesn't have to do that. Maybe if the advisory team, the wealth advisor who's managing the account, sits the beneficiary down and says, don't pull the money out. Mom and dad didn't want you to do that. This is there to protect you. and will continue to invest it. This is a pure income tax save. Maybe the beneficiary will listen. I don't think you'll have 100% win rate, but I think, a good advisor that's been prepping the kid, don't touch the money when you can, may, be able to do that. So BDOT is a very creative approach to solving the problem, because the money, once that power lapses, remains in the trust and arguably can be protected. Now, if the child has a claim at that time and has the right to pull the money out, or divorce at that time and has the right to pull the money out, I don't think it's going to be very protected. But if years later something arises and it's left in the trust, I think you have a chance of success. So a BDOT is an interesting concept. Some of the articles that I've seen talking about using a charitable remainder trust to address CRTs. I didn't say that right. Many of the articles I've seen that have proposed using CRTs to address the tax consequences post-Secure Act of a retirement account don't address the use of a BDOT. And a BDOT may be, and I gave you, I think, a useful illustration, may be a good way that you can circumvent those requirements. Now, that doesn't mean that CRTs can't provide a valuable option, but I think if you're advising a client, you may want to put lots of different options on the table, and we've given you several already. So keep that in mind. I already talked about this, so I'll just say very quickly, but one of the issues is if all this money has to be paid out and we have a 50% divorce rate, now what? It doesn't mean that the assets necessarily lose their character as an inherited asset. They shouldn't, but reality, practicality, clients tend to commingle everything when they're married. And unless this asset is kept pristinely separate, it's going to be an issue. That alone is a reason, in my view, to keep a trust. And if the BDOT approach or CRT approach can keep it separate, that's very helpful. We talked about a conduit trust. You can't accumulate distributions. So the conduit trust under old law and still under current law must pay out whatever is required to come out of the plan. So under old law, if an RMD was to come out over life expectancy, that's all that came out to the kid. The trustee of the conduit trust is required by law to pay out anything it gets immediately to the beneficiary named. So in year 10, when the entire IRA must be paid out, the trustee must immediately pay it out. Not exactly great from a divorce and asset protection perspective. So again, shifting to accumulation trusts, looking at BDOTs, and we'll come to CRTs in a few minutes. Planning rule on slide 23. One of the things that you could do is you got to revisit with clients who are relying on the tax benefits of the stretch to motivate the heir, the child, not to pull everything out to do it. Now, there's several types of trusts that you can have to hold plan assets. One is the conduit that we've explained, and the requirement that the trustee of the conduit trust pay out immediately anything it gets from the IRA. The other type of trust, which I think has a very different relevance now post-Secure Act, especially from an asset protection, because the conduit trust was kind of gutted because in year 10, the whole thing comes out. Now you got this big lump of money in the beneficiary's hands. Not a good result at all. The accumulation trust does exactly what its name says. It permits the beneficiary to hold, the trustee to hold the money in the trust and accumulate it. That's why it's called an accumulation trust. So that can protect the IRA and the plan balance from a fiscally irresponsible beneficiary or a beneficiary who might get divorced or sued. But you got to consider the tax consequences. In year 10, the entirety of the IRA is paid to the accumulation trust. And unless some of that is paid out, you have a problem because you're going to be in a maximum marginal tax bracket. Now, some of the things that can be done, we're going to talk about. So, for example, it's not in the slide, so let me just say it. The accumulation trust trustee may pay pieces out to the beneficiary in the intervening 10 years to dampen the marginal tax rate and the amount of income tax in the marginal bracket. The problem with that approach is that you're now losing the protective envelope of the trust. We've talked about the B-dot approach. Going back to the conduit trust, the issues that we've talked about, I think in many cases will suggest that a client change to an accumulation trust in their planning, which means revising, let's say, the revocable trust that includes the conduit trust provision and changing that to an accumulation trust. And I would revise the beneficiary designations just to make sure that it points to the correct trust. So that's certainly an approach that can be done. We've talked about the B-dot already. Let's go on. I've talked about this. You can take the distributions during the 10-year period. Another approach that's kind of a spin on the same thing. What beneficiaries does the client want to name? You know, maybe they have other beneficiaries. They may have named one heir, one niece to receive the retirement plan, and she was going to stretch it. They may have selected the youngest grandkid. So maybe now if you have to shift from a conduit to an accumulation trust, you name multiple beneficiaries so that you dampen the tax impact, especially if you do a B-dot for each of them. Now, life insurance warrants more consideration. If you have an IRA and in year 10 you're going to have this substantial tax cost, then perhaps you could use life insurance to build a side fund to cover that tax cost. But I think the life insurance discussion post-Secure Act has to be much broader and deeper, because as we'll talk about in a few minutes, clients may want to really reevaluate their entirety of their plan, and we'll talk briefly about that. So here's a simple little case study on slide 29. Taxpayer had $1 million in her estate, $1 million in her IRA. She had a child from a prior marriage and a new child from the current marriage. Who was never adopted. So the minor child, because it's not adopted by her, won't qualify for the child exception under the eligible designated EDB rules that we're going to talk about. Pre-Secure Act, she named the minor as a sole beneficiary with a conduit trust to get a stretch. That doesn't make any sense anymore, because there's the kid's going to have to pull it out in year 10. They could be 15 years old when they have to pull the whole thing out. So maybe what she does is flip-flop the entire plan and name the older child as the beneficiary, because in year 10 they can get the money, but at least they're mature enough and responsible enough to handle it and avoid using an accumulation trust. Maybe just give the IRA out right now instead of having the conduit trust altogether. And the minor can be named a beneficiary of assets under the estate, where they could be put in a trust to protect the minor. So it could be a complete flip-flop of everything. Roth conversions is something else that may warrant consideration. I'm not sure it's a winner. I think it really depends on what assumptions you put into the model. I would have the wealth advisors evaluate that. Maybe one thing, by the way, to consider, if you do a Roth conversion and tax rates are lower now than in the future, that could be a big advantage. If the client is worried about asset protection, and I find most clients are or should be, if they're not already worried, they should be worried. If you convert an IRA to a Roth and you use non-plan assets and state law protects a Roth from creditors, you've just moved effectively non-protected assets into a protective envelope. Don't forget that piece of it. But a Roth conversion, perhaps spread out like little pieces each year, may not raise the client's tax rate and may mitigate some of the harsh tax cost of the 10-year payout rule. But keep in mind, it only addresses the tax cost. It doesn't address everything else. You may be able, and here's another charitable piece I wanted to highlight, which is, old hat, you all probably know this, is to try to coordinate charitable giving to offset the gain on a Roth conversion. Now, we got to talk about eligible designated beneficiaries, which I've mentioned a couple times already. EDBs are the new special rule. There's 5 eligible designated beneficiaries. These are the folks that still get the stretch even post-secure. Surviving spouse. So if husband dies, wife can roll over the IRA and continue to take a payout over her life expectancy. And if, defer until she's 72 now to take anything out. Chronically ill heirs and disabled heirs qualify, and there's special rules that they can even do that in an accumulation trust, which is protective for them. Somebody who is a child of the plan holder, and we're going to talk about that, is an eligible designated beneficiary with restrictions we're going to talk about. And a person who's 10 years or fewer younger than the plan holder can also qualify for it. So those are the 5 categories of people that get a stretch. Everyone else has got the 10-year rule that we've talked about. Spouse can roll over. Spouse can use a conduit trust to hold the plan balance and withdraw over life expectancy, kind of just like prior law. And it starts at 72 instead of 70 and a half. And that's a great plan for a spouse. Now, keep in mind that when the spouse dies, the 10-year rule kicks in. So the spouse can pull out over life expectancy, but when the spouse dies and leaves the assets to some other heir, you have the same 10-year rule we talked about before. So again, insurance may be something people want to give some thought to in a different way than they did before. Sorry about that. Disabled beneficiary qualifies. And just to cut to the chase, the problem with I mean, it's wonderful that Congress thought to have some compassion for a disabled or chronically ill person, but their compassion was too limited because the code definitions of what it requires to be disabled or chronically ill are so restrictive that many people who really have very substantive challenges cannot qualify. So a disabled beneficiary is an individual who's unable to engage in any substantial gainful activity by reason of any medically determinable physical or mental impairment, which can be expected to result in death or to be of long, continuing, and indefinite duration. So that's pretty restrictive. Any substantial gainful activity. Maybe working in a sheltered workshop is not considered substantial gainful activity. But if the individual has a challenge, and because of that challenge is really not self-supporting and has a need for the protection a trust affords, they still don't get the stretch. So you have to be very, very careful as to who qualifies. And it's much worse than that. And I'm sorry Congress hasn't done a more compassionate job of this. So one of the things to do is perhaps you try to use life insurance or other family assets and fund a trust for the beneficiary, whether it's supplemental needs or not is a different discussion, not our topic today. But that way you can use non-retirement assets to fund a trust, a more traditional trust, to protect the beneficiary that's disabled or chronically ill or has challenges, and leave the retirement assets to somebody who will handle them better because you can't get the stretch. Now, the other thing is, if you have somebody who is in fact meeting the requirement of chronically ill or disabled, you may want to, and I actually had this conversation with a client, they actually had set up a plan where the IRA had been left to 2 of their children, and a special needs child was given an insurance policy and a trust that had supplemental needs provisions. It would probably be better from a tax perspective if they could flip-flop the plan and have the special needs beneficiary who would qualify get their very large, or at least part of their very large IRA, because they could stretch it over that person's lifetime, and instead give the insurance, which is out of the estate, to the other beneficiaries. It certainly would have a tax advantage. But then here's the problem with the Secure Act. How do I change that? How do I change an already irrevocable trust? Can I change it? And in that particular client instance, I'm not sure we can make that all happen. So we really need to rethink the whole plan and see what we can do. Now, if, for example, the trust structure I just told you was a term policy, maybe they buy a new policy and set up a new ILIT, irrevocable life insurance trust for the children, and let the old one lapse if it's comparable. I don't know that that'll make sense economically. And name the special needs child as the beneficiary of the IRA so that it goes into an accumulation trust where a special needs or chronically ill beneficiary can qualify. Couple of points, and this may come later, but I just want to say it now because it's important. A chronically ill or disabled beneficiary can qualify to stretch in an accumulation trust. The other EDBs can't. It has to be a conduit trust. So keep that in mind. Now, another category is minor children, but this, oh, I'm sorry. I thought of the point I was struggling with. This is another problem. The definition of, or the timing when you determine if somebody meets the definitional requirements of disabled or chronically ill is at the death of the plan holder. So if somebody is disabled at a later date and needs the protection of a trust, they won't get the stretch. That seems a little inherently unfair, but that's the law as I understand it. Minor children work, but this is, you got to be very careful. A minor child is only a minor child of the plan holder. It's not a grandchild. And if somebody has a relationship like a child, so they got married but didn't adopt that their spouse's child, that's not their child. You don't qualify. Next, you get to defer until you become an adult, until you reach the age of majority, and then you're subject to the 10-year rule. So it's not a full life expectancy, it's a partial life expectancy. And what is the age of majority? It could be 18 or 21, depending on state law. If you're pursuing a course of education, until that education is completed, you can continue to defer. So if a 10-year-old kid inherits an IRA, they can pull out in small, modest increments for life expectancy until, let's say, 18. If they're in college until 26, so they can continue to pull out then, and then at age 26, that's their last life expectancy pullout. And starting the next year, as I understand it, they'd have a 10-year payout. So if the minor child was age 10, they had 16 years until they graduated from the specified course of education, and then another 10 years, so you got a 26-year stretch. That's still a pretty good stretch, so that's still valuable to plan for. Yeah, keep in mind what's a child. It's very restrictive. Sorry. I apologize about the scrolling, but because I converted your handout this way, I have everything here, including the schematics, and if we have time, the articles to talk about. I have to scroll instead of just clicking next slide, so it's a little inefficient, but I thought it was better to have the whole handout so you could follow along. The final of the 5 categories of EDB, eligible designated beneficiaries, is someone who's not more than 10 years younger than the plan holder. And there's a simple example on the bottom of slide 44. Plan holder is age 80, has an unmarried partner, so the spouse exception doesn't apply, who's age 71. They're not more than 10 years younger. So if the plan holder dies and bequeaths the IRA to the 71-year-old unmarried partner, they can withdraw the plan balance over their life expectancy. Not a big deal. We have clients that sometimes have an unmarried partner, a sibling. Those are probably some of the rare instances where that may apply. I don't see it as a very significant planning issue to address. We've already talked about how clients need to be revisiting their beneficiary designations to address all the things we've talked about. The example on the bottom of 47, IRA owner bequeaths some or all IRAs to grandchildren to maximize the stretch. Now they don't get it. They only get 10 years. Maybe they revise it, leave it to their kids because that was their intent. The only reason they left it to the grandkids was because of the massive stretch that they would have gotten. Now, if the client had gone out and bought life insurance to give an asset to the kids so the grandkids could stretch the IRA, maybe you revisit the whole plan, as I've said earlier. You can't really do any of this in isolation. And as I said in the beginning of this discussion, I don't think I've had a single client, despite all the mailings, emails, seminar email blasts that I've done to my client base, I don't think I've had a single person come in to specifically address this. Now, this is really important, and I've said this a few times, so let me just reiterate. You need to revisit the whole plan, not just what happens with the beneficiary designation. And I've given a number of examples. So here the plan was to bequeath IRA assets to grandchildren and had a life insurance trust, purchase life insurance to benefit the children. You may want to revisit the whole plan. But what can you do with the insurance trust? Now, it may be possible with the insurance trust to do a non-judicial modification and change the beneficiary designations to a pot trust for everybody. Depends on state law, depends on the terms of the trust. You may be able to decant if state law permits or the trust has decanting language, and address it that way. So let's revisit everything. That's really important to do. So here on slide 50, IRA owner might have the IRA assets bequeathed outright to heirs, assuming the tax benefits of the stretch would have motivated the heirs to defer tapping the IRA. That's an assumption, and I can't prove, I haven't been able to find data to see if that ever really happened. But that's one of the assumptions that we talked about as a premise that I think drove a lot of client planning. Now that they don't have the buffer of that great tax benefit, they may want to use an accumulation trust so they're, they can really control the heirs. So again, the whole plan has to be revisited. And as I illustrate in the example on slide 51, it's the kind of concept we've talked about before. You may want to now bequeath IRA assets to a disabled or chronically ill beneficiary if they qualify for the stretch. You may want to specifically bequeath IRA assets to more responsible people and create a trust under the will or rev trust for heirs that are less responsible. Now, I don't know that this will work. I'm not sure it will, but I was just pondering when the Secure Act came out. Can I give a trust protector or maybe a limited or special power of appointment to somebody in a non-fiduciary capacity? So if the trust protector under state law or the instruments of fiduciary, I got to name somebody different. The power to tweak some of this stuff, change some of it, modify it, so that if things change as time goes on or people develop differently, there's some latitude and flexibility. Something to think about depending on how the plan works. And that's an illustration on 53 of that idea. Slide 54, I note that as I understand it, the determination of disabled or chronically ill is on the death of the plan holder. Kind of unfair, because if somebody gets sick later, you really want them to stretch, and now you can't. I apologize. Let me just get to where I was. Okay. So now let's talk about CRTs. And I've tried to point out some of the charitable things as we've gone through this, and I wanted to give you a foundation of the Secure Act to understand it. Now, what might a CRT do? Now, again, keep in mind, I don't think it's right to just direct the client to name a CRT as the beneficiary without going through a lot of the stuff that we went through, which is why I said early on, I think we have to have a broader discussion in order to properly discuss CRTs. If the client is really concerned about the compressed tax rate and can just name, multiple people as beneficiaries so it's spread out, or if the client can use a BDOT mechanism or partial Roth conversions over many years while the client is alive to dampen that potential tax benefit, does it make sense to necessarily name a CRT? Perhaps not. I think you really need a much more complex, holistic discussion of what works. Now, for those that want more basics on CRTs, the articles below that I don't know that we'll get to, and they weren't part of the program. I just wanted to give you more material. We'll explain, Crutz, Kratz, Nim Crutz, Flip Crutz, and so on. There's a whole bunch of basic discussion there. And I also mentioned that on my firm website, Shenkman Law, under the webinar tab, you'll see a number of CRT webinars if you want more general background, but that's not what we're going to cover today. Just quickly though, some of the basic concepts that you need to understand for a CRT. You have to name a non-charitable beneficiary. That's the child or heir. It can be for life expectancy or a term up to 20 years. There has to be a minimum 5% payout each year, but not more than 50% to the non-charitable beneficiary, say the kid. There's two broad types of CRTs, a uni trust, which pays out a percentage determined each year. So if there's $1 million and it's 5%, it's 50 grand. And then next year, if it's $1,100,000, it's 51 grand. A charitable remainder annuity trust or CRAT, you determine the 5% of the asset value contributed into the trust. It'd be the same 50 grand on the $1 million, but it stays 50 grand in all future years. Under the current interest rate environment with interest rates so low, it's very difficult to make the numbers possibly work for a CRAT. So that's probably not going to be the case. CRUT can have a 20-year term, and that may be what you in fact use for the IRA. The actual actuarial value on slide 57 of the remainder interest has to be at least 10% of the value of what's contributed. That's what goes to charity. One of the articles below with Richard Fox and Jonathan Blattmacher explains the economics of CRTs. That in effect is the price that you want to pay, that you are paying, that you have to pay to get the tax deferral mechanism or benefit that the CRT affords. And what that article explains is you don't ever want to make the remainder more than 10%. If the client's charitably inclined, that's wonderful. Just have them give a donation to charity. If you're doing a charitable remainder trust, you never want to specify or calculate the value to be more than the required minimum 10%. That's the toll charge or rental fee to get the tax benefits of a CRT. And those tax benefits and the deferral they provide is the name of the game for CRTs. And you get let's say if it's done in the estate, you get an estate tax charitable contribution deduction for the present value of the remainder interest going to charity. Now, if on death, the IRA is paid to the CRT as beneficiary, the IRA in effect liquidates, I didn't say that right, the CRT, the CRUT, will liquidate the IRA immediately, and then it'll make its distributions, let's say over the next 20 years to the named beneficiaries. Because the CRT is a tax-exempt vehicle, there's no current income tax cost on the liquidation of the IRA. Now, the beneficiary will get an allocable share of the CRT's taxable income each year. With an IRA, it's all going to be ordinary income. The advantage of the CRT plan is that the plan or IRA proceeds can be paid immediately after death of the plan holder without any income tax being due. So you don't have any current tax problem. And then the money is spread out over, say, 20 years, which is a much better benefit than in many cases can be a much better benefit than the IRA being paid out in year 10 at a compressed trust tax rate to the beneficiary. And that's the heart of why the CRT may be a valuable option for some clients. There's a couple of examples here. I'm going to not go through all of them. But the point is to illustrate how you can even structure the IRA to reduce the overall estate tax cost to the client, to the plan holder, down to zero. So you could leave the IRA if a client, let's say we have this current $11.58 million exemption, it doesn't change. If the client's IRA is $3 million and their estate is worth $13 million, if the IRA is left to a CRUT, not only do you get the income tax benefits, but you may have avoided any estate tax as well. So you can, depending on the numbers, you can coordinate this with both the estate planning and the income tax planning. Now, oops, oh, sorry. I don't know if that was visible, sorry. On slide 63, one of the things that I mentioned is the IRA owner may also purchase life insurance to replace the estimated value of what goes to charity. Now, in general planning, leaving aside IRAs, that often was dubbed or called a wealth replacement trust. And the concept was pretty simple. It's actually combining several ideas that made a great sales pitch for insurance. So you're going to donate your highly appreciated Apple stock to CRT, and let's say the value of the remainder interest is estimated at $100,000, $1 million. So $1 million is the value of what's going to charity. Everything else is going to be paid out in unit trust interest to beneficiaries. The clients could go out and buy $1 million life insurance policy held by an ILIT, irrevocable life insurance trust, and that insurance policy would theoretically replace the value of what's going to charity. Now, it's a nice way to sort of show a client that you can use the CRT, you can rent the tax benefit by virtue of the payment to charity, and you can even replace the tax the charitable gift that's going to charity with an insurance policy. Obviously, you have to look at all the numbers because there's a cost for the insurance and so on and so forth. But combining that inside an ILIT with the current $11.58 million exemption is not necessary for all but the wealthiest clients. But if the exemption drops to $3.5 million, if there's a change in administration in Washington, then certainly that concept may come back and be more popular. And it certainly could be applied in the same context as what's being done with an IRA naming a CRT, a CRUT, as the beneficiary. But keep in mind that if you estimate that there's 100,000, 200,000, if that's the deduction on the present value calculation, that may only coincidentally be the amount that ultimately goes to charity. The amount that goes to charity is going to depend on the rate of return of the assets invested inside the CRT and a whole bunch of other factors. So there's nothing wrong with using this wealth replacement concept, but if you want to dig a little deeper to see what the real numbers are, it's a lot more complicated than the simple general discussion. Now, we've explained the use of CRTs. I explained how you need to address them in a broader context of, does a BDOT solve the problem? Does partial Roth conversion solve the problem? Does naming multiple beneficiaries where you had one solve the problem? Does naming a disabled beneficiary get you the stretch that you otherwise thought you were getting with a different beneficiary, and so on and so forth? So you really have a lot of different factors to look at to give a balanced view of whether a CRT makes sense for a client. I also think that the cost and complexity of doing this, unless the IRA is large, and I don't quite know where to draw the line on large, but the client's not going to spend the money to have their planners create a CRT document and to absorb the complexity of the plan, not just the cost of the legal work, unless there's enough money involved. So in a lot of cases, the CRT is just not going to be practical. The BDOT may be simpler, maybe, but again, raises its own issues. So I think you really do want to take a holistic view. And frankly, the best way to do it, I think, is to have the estate planner, wealth advisor, insurance consultant, accountant. Everyone should kind of collaboratively address this. I really do like the team approach to all of this. And by the way, just my own 2 cents as a side comment, I'm sorry, I can't resist, but I can't see you. So if you're yawning when I make my side comments, I don't know. But I'm a zealous believer in the team approach. I think, each expert on the team adds their own areas of knowledge and experience. I also find that clients tend to never tell any one advisor everything. They always seem to tell different advisors different things, so that if we all kind of get our heads together, we kind of get the whole picture, or at least most of the picture, what the clients really got going on. It's amazing to me how the best wealth advisors on the planet that are the most thorough and detail-oriented people, somehow the clients never tell them about a couple accounts someplace else. They just didn't want them to know about it. Or how a wealth advisor will come in and tell me about a health issue in the client's family who's been a client for decades, and the client just never told me about it. But the person that's often missing at the table is the gift officer. So if we're going to talk about charitable giving as part of our planning, whether it's a CRT for an IRA, a CRT for charitable business bailout, as we talked about much earlier in our program, or anything else, the gift officer is just not at the table enough. And I think it really behooves all of us as the attorney, accountant, financial advisor, wealth advisor, trust officer, bring the charitable gift officers in. I did a program on one of our charitable RV speaking tours a few years ago. I think it was for All Children's Hospital in Florida. And they had a large number, they had a very large charitable giving department. And I asked them, just out of curiosity, how many times have you actually had a seat at the table with all the other advisors and had a balance sheet for the client so that the proposals that you were making were really rooted in what the client's actual economics were? And it almost never happened. The whole room full of people, I think there was 1 or 2 people that a few times it happened. How can a planned giving officer, a charitable giving officer, possibly do the best job they can to guide our clients on something as important as charitable giving if they don't have a seat at the table and they don't have all the financial data that we have? So little pitch there for the charitable giving officers. Now, one of the things, as long as we're talking about Secure Act, what about old trusts that maybe no longer are really serving the purpose? Your client has a revocable trust that has a conduit trust. We realize it's really not optimal, and the client's incapacitated. What can we do? If the client's not incapacitated, sign a new document. We've talked about that. Revisit the whole plan. You may be able to use a non-judicial modification if everybody's alive. I had indicated here that if the plan holder is not alive, changing that trust through a non-judicial modification may not be possible. I believe Delaware has an option that even if the settlor of a trust is deceased or incompetent, that you may be able to do a more limited non-judicial modification. I haven't actually thought through whether that would be sufficient to accomplish some of our goals here, but you can certainly look at a non-judicial modification. You may look at a possibility of decanting the trust if state law or the trust document permit it. You may even have to go to court and try to reform it. I can't really speculate well what a court might say, and whether a court would even be willing to entertain it. You set this up as a conduit trust because you thought they'd get small slices over 30 years. Now they get a lump sum because the tax law changed. Will they let you reform that into an accumulation trust to protect the beneficiary? I don't know. And I don't know if a client would be willing to bear the cost and the complexity and uncertainty of that kind of process, but certainly something to look at. IRAs inherited before 2020, the old rules apply. And that's what I love about the tax law. So it's not enough to get our head around all these new rules that are really kind of complicated. And I think you see the intricacies of what you have to look at to even recommend a CRT for an IRA post-Secure Act. But we still have to remember all the old rules, and then you have to pivot where old rule, new rule, old new rule. It's complicated. Some of the other changes, which I'm sure you all know about, and then we'll mention some of the charitable ones, another charitable one rather. We used to have to stop making contributions to an IRA at age 70 and a half. That was the same age under prior law that RMDs had to begin. Now RMDs begin at 72, not 70 and a half. But you can make contributions without any age limit. So you can continue to contribute to an IRA. I guess that's a nice thing for people that can. I always liked IRAs, even though they're, for a lot of clients, a small dollar item, because it's a very inexpensive asset protection income tax deferral tool. QCDs, qualified charitable distributions, phenomenal planning tool. I think there's another slide on it, but let me just speak about it here. Client can direct up to $100,000 a year, go direct from the IRA to charity. The income tax benefit of this, and it's discussed in more detail in one of the articles attached, and I gave you, I think, at least 3 different articles. But a QCD, you can direct up to $100,000 per year to charities from your IRA, and the benefit of that is, with the limitations on standard deduction, itemized deductions, and the high standard deduction, many clients have lost out on the ability to get a charitable contribution deduction, but they can easily get it with very little cost and planning by doing a QCD if they qualify. How so? And this is the cat's meow for people that are old enough to qualify. 70 and a half remains the rule, not the new 72, because if you had to take an RMD of 20 grand and that 20 grand instead goes to charity, it doesn't appear in your gross income from the IRA distribution. It goes straight to charity. You don't get a deduction, but you don't include the income. So it's a dollar for dollar offset, as if you didn't have the restrictions with the large standard deduction and the restrictions on itemized deductions. For clients of the right age, charitably inclined, a QCD is phenomenal. Now, one of the quirky tricks or consequences of the Secure Act is that if you make contributions to an IRA after age 70 and now I think it's 72 now, but maybe it's still the old 70 and a half, the QCD is reduced by the amounts contributed under the new tool past 70 and a half. So that you, in effect, if you're making late in life contributions, your QCD is going to be reduced, which is an unfortunate spoiler effect. So just be mindful of that. And I apologize if I was unclear. I am unclear as if it's 70 and a half or 72 for that particular rule. Here's a little more information on QCDs, but we pretty much covered it. To kind of wrap up. So let me take a minute because we're nearing the top of the hour, and let me not just wrap up on the Secure Act, but also the other things that we discussed, because we covered a couple of valuable, I hope, for you planning ideas for this year. So let's do a quick summary, and then we'll conclude. So the Secure Act has made incredibly dramatic changes to planning for retirement assets. Some of those changes directly and importantly affect our topic today of focusing on charitable giving. QCDs remain a phenomenal tool given the 2017 Tax Act restrictions on itemized deductions and the increase in standard deduction. And as I said, there's an article in the materials that'll walk you through more of that. There's a quirky spoiler effect if you're making late in life IRA contributions for the QCD, so just be wary of that. One of the focuses of our discussion on the Secure Act was how you can use a charitable remainder trust to mimic or sort of salvage a stretch on the IRA. But I think it's not only a great tool, and I think it appeals to a lot of clients. My wife and I are actually thinking about looking into it for ourselves, for our kids, because we think it's a neat idea. But you need to really look at it in a very broad, holistic way. And I think I stressed that point several times during our discussion. You want to look at BDOTs and Roth, partial Roth conversions, and naming other beneficiaries. And I think really you not only need to look at that, but you can't look at the retirement plan beneficiary designations in isolation. For a lot of clients, you really need to revisit the entire plan holistically to see where you end up. Now, let me go back and just do a quick recap or summary of what we talked about before the Secure Act. So I tried to set the stage for what I see going on in the current 2020 planning environment. I tried to give you some indication what I perceive to be the driver for 2020 planning and the uncertainty of the assumptions underlying it. But nonetheless, I think it makes sense. It's prudent for people of wealth to plan aggressively, because what if those assumptions come to pass? Democratic sweep change, retroactive tax law. I don't know that all those will come to pass. I'm not predicting what may happen. But if it does happen, I think wealthy clients will be far happier having taken aggressive planning actions in the time that remains in 2020. As part of that, I also talked about how the change in capital gains rate that Democratic nominee Biden has proposed may impact funding a charitable remainder trust this year, how you may just want to have the capital gains tax incurred. I haven't projected or modeled that out, so I'm sure there's some wealth advisors on this call that could do a better job at telling you if it pays or not. But I think before you use a CRT on the sale of a business because a client's concerned that next year we're going to have a higher capital gains rate, double potentially, you want to really look at the numbers and see if it makes sense to do, because it's certainly not going to be nearly the benefit a client wanted if they defer capital gains and end up paying a tax at double the rate that they would if they just paid it now. And maybe they just make an outright donation instead of the CRT. But I would certainly have somebody model that out if there's time to do it. And that's going to be a problem we all face as we get closer to year end. There's not going to be time to do the modeling and thinking that we want in order to help plan. I then talked about how, given those potential dramatic, harsh changes if there's a Democratic sweep, again, not predicting anything and not being political, just talking as a tax attorney, that clients with large family businesses, real estate holding large wealth, are going to look at note sale transactions when they're well beyond the level we're just using gift exemption is sufficient for their planning. And I illustrated how you can build in a charitable component in the spillover or defined value mechanism on a note sale transaction, and tried to give you a concept of how that can help even clients that are not charitably inclined protect a large note sale transaction. So I hope this was practical and valuable, and I want to thank our sponsoring charities and Glenmede, and I don't want to miss any names, so forgive me if I have, and I wish you all good luck.
Thank you, Marty. Thank you so much, and good morning, everyone. If you weren't on when I said good morning earlier, I'm Robert Nomberg, President and CEO of Richmond Jewish Foundation. Again, thank you for joining us. This was the 15th annual Hirschler Professional Advisor Seminar, and it's the biggest crowd we've ever had, so thank you for joining us. Marty, thanks again so much for sharing your wisdom with all of us. We greatly appreciate it. And as you just said, thank you to the Bon Secours Richmond Healthcare Foundation, to Glenmede, and to the Edward S. Hirschler Memorial Charitable Endowment Fund here at Richmond Jewish Foundation. We will send the CLE and CPE forms out today. So if you do not receive them today or tomorrow, please email me or Joycey. Let us know. We'll send them out to you. Thanks again, and have a wonderful and safe day.